let's recap through what has happened in the markets and the close. The Dow closing up or finishing off above 8,000 points, higher by almost 500 points, but still down for the week. The same thing with the S&P, higher by, as you can see, 6.3%, trading at or closing at 800. Pretty much 800 even. So we're seeing this. We saw this late day rally on the back of this news, of course, that President-elect Barack Obama has indeed nominated Tim Geithner of the New York Fed Treasury Secretary, and that official announcement could come on Monday. Well, let's bring in our featured roundtable. Mark Pato is U.S. market strategist at Cantor Fitzgerald in Reno, Nevada, and Jack Malvey is a fixed income strategist at Barclays in New York. Jack, perhaps I could start with you because I did notice that despite the fact that we saw a major rally in equities on the back of this news, bond markets didn't do a whole lot. I mean, they were down already. But why is that?
Well, I think the bond market was chugging into a weekend close, and I think that in the bond market, maybe it was so well expected. I'm not sure why it would be any revolution in terms of valuations. You
think it was well expected,
yes.
Mark?
Well, I think that any of the choices that were being bandied about, whether it be Volcker or Summers or Geithner, that all three would have been something positive for the market. The market just wanted to get it out of the way, especially getting it before the weekend. I think that was important. But this flight to safety has been going on for several weeks and got intense in the last couple of days.
Well, Jack, I wanted to get back to you because do you think that this means that this flight to safety we've seen, of course, we had record yields, low yields yesterday on Treasuries. I mean, is this flight to safety going to ebb with this type of news?
Well, I don't think just on this news alone, but I think in terms of developments over the course of the next few months here, we probably have not seen the conclusion of capital preservation, flight to safety movements in the market.
What do you think Geithner is going to have to do to restore that confidence then?
Well, I don't think it's him alone, certainly. It's the Obama administration and also the Fed. And I think there'll be a variety of programs. Fiscal stimulus in early 2009, auto bailout, let's return to that, see where that goes. A whole host of measures are likely to come out of the Fed as well to get things rolling again.
Well, I mean, we've had guests on our program, on my program earlier in the morning, saying that fiscal stimulus is going to be the biggest thing accounting for the markets. Mark, is that something you agree with, or you think it's got to be a whole host of measures?
It will have to be a whole host of measures. We're going through a massive deleveraging, and it's not just a recent event. We probably got to this point over the last decade of leading up and building into this position. So as they delever the financial institutions, they're going to have to flood them with money. I think the biggest problem with the market over the last week was that Paulson said he wasn't going to go after that $350 billion. He needed that in his pocket. We definitely needed that liquidity, and we needed a stimulus package also from Congress.
Okay, let me bring in our third guest, Peter Schiff, who oversees $1 billion as president of Euro-Pacific Capital. Just managed to rush in on this Friday afternoon, Peter. Listen, I was just asking our other guests, Jack Malvey as well as Mark Pato, about this announcement about Tim Geithner. We're seeing a reaction in equities, not so much in the bond markets. It's partly expected. What is your reaction to this? You're a bear in the market.
Yeah, look, I think it's a short covering rally. I don't think it matters who they put as Treasury Secretary. The economy is in terrible shape, and everything the government is doing now and everything the government is likely to do when Obama takes over is going to make the situation worse.
It's going to make it worse.
Of course. Remember, we got into this mess because we borrowed and spent too much money. The solution isn't going into deeper debt to encourage Americans to spend even more money. We need a serious recession in this country, and the government needs to get out of the way and let it happen. We need higher interest rates, we need more savings, we need more production. What's happening right now in the economy, this is not the problem. This is the consequence of the problem. The problem is that for years we borrowed money that we couldn't repay. We borrowed money to consume. We ran up trillions of dollars of debt, and now we're too broke to pay it back. And we have a phony economy that's been propped up by foreign governments and foreign workers who have produced the stuff that we bought and lent us the money to buy it. We need to recreate a viable economy in this country again, and unfortunately, that comes with a lot of pain, and we have to suck it up.
Mark, Jack, you care to disagree?
I disagree with a lot, but I'll stop.
No, go ahead. That's why you're on. What do you disagree with most?
Well, I don't think that we need to do nothing. I think that that would be irresponsible, because I think government policy is needed to cushion the downside here. And I think on both sides of the aisle in Washington, it would be the case that, as shown with even the Republican Bush administration, they're very aggressive and active in trying to cushion that downside.
Yeah.
I agree with Peter that certainly there are areas that we have been irresponsible collectively over the course of a very long period of time, but to effectively do nothing, probably not a great idea.
Yeah, because I've had Jim Rogers on my program a lot, and he sounds the same tone as you in many ways, saying that we should do nothing. The U.S. should do nothing. And is there no middle ground, though?
No. Remember, back in 2001 and 2002, I was highly critical then of the Federal Reserve and the government's attempt to mitigate that recession. Had the government done nothing back then, we would have had a worse recession, but our economy would be in much better shape today. The housing bubble, all this reckless borrowing and spending, all these bankruptcies now on Wall Street are a direct result of what the government did back then to mitigate that recession. And unfortunately, the government is now sowing the seeds with a much bigger crisis. What we're now setting up is going to be a currency crisis. It's going to be a run on the dollar. They're going to unleash hyperinflation in the United States, where consumer prices and long-term interest rates are going to go through the roof. And it's going to be much worse. Unfortunately, government policy can't help. It only makes it worse.
Well, there's a point there, Mark. I want to bring you in, of course, into this as well. But, Peter makes one point, though. We can't be bailing out every single company.
But we don't have money to bail out anybody. We're broke. We're borrowing the money from China. We're borrowing it from Saudi Arabia. We're running it off a printing press.
Okay, but Mark, I want to get your response, because obviously you disagree, right?
Yeah, absolutely. I think that this is the solution that you have to have is printing press. You got to print the dollars. I understand what you're saying. You're worried about inflation. The thing is the whole inflation of this was built up in the last decade. That's what spurred on this, using the derivatives, using the leverage. Look at it now like a dried up sponge. You got banks that are 30-to-1 levered. You could pour 20% into it and it would just soak it up. Nothing would happen. There would be no inflation. As long as you regulate and say, now you have to be 10-to-1. No more 30-to-1, no more 40-to-1. You got to be at 10-to-1. And they can add liquidity to the financial institutions and nothing would happen. They would have to hold it in treasuries and it wouldn't make a difference. But we have to get back down to that 10-to-1. And that's really where this is going. I completely disagree. We're not facing inflation. We're facing deflation.
We let them go down to lower ratios by letting these companies go bankrupt. That'll wipe out a lot of their debt. When you're printing money, that's the definition of inflation. And what's going to happen is the dollar's going to fall through the floor. Asset prices are still going to fall, but consumer good prices that Americans